Hey, what's going on? My name is Andrew from the website www.einvestingforbeginners.com. And this video today is to show you how to invest in the stock market by looking at one of the most simple valuations that you can for stocks, and that's the PE ratio. So I'm going to start with a little bit of the background of the PE ratio, then show you exactly how to calculate it for any company, and then finally give you two examples where a high PE ratio actually led to a stock price falling and a low PE ratio leading to some stock price gains. So first, a little bit of background, the PE ratio. It's the most widely used valuation in the stock market. It's the most widely accepted, and it's the most basic, just the best place to start when you're getting into the stock market, and you really need to learn how to calculate this valuation and how and why it works. So that's what this video is going to try to show you. As you try to understand the stock market, you have to realize that the stock market goes through very many ups and downs. There are bear and bull markets. You'll tend to see that during the bear markets, PE ratios and other types of valuations like this tend to be lower. But at the same time, you won't see as many gains as you will in a bull market. But with the bull market, there are more gains, but also more bubbles, more higher valuations, and you start to see these high valuations get higher and higher. People start to kind of move away from the PE ratio and will invest in riskier stocks with higher PE ratios, just because in the present past it's been a little bit successful. So you're starting to see that now. I'm recording this in May of 2013. You're seeing more people willing to take risks and invest in higher PE ratio stocks. The thing is with this is as the market gets higher and higher and higher, eventually that bubble will pop, and so all these high PE ratio stocks will fall, and they will fall the hardest. And so you'll tend to see that, and that's how a lot of people get burned. So if you can use things like the PE ratio to protect against that, then you'll be much better off, in much better shape. So that's really the background. Next, I'm going to show you how to calculate the PE ratio. So you can find this post on the website as well. Basically, it's real simple. PE, or price to earnings ratio, is calculated by taking the price, dividing it by the earnings. And so there are two different ways to do this. You can take total price divided by total earnings, which is what I did in this post here. You can see step 4 out of 7, how to calculate PE ratio. And basically, to take the total price, you want to find the market cap. To get the total earnings, you can get that from the company's annual report 10K, which I showed here. Or there's also a simpler way to do that, which I showed in another post. Let me just click on it here, where you can take, instead of the total price divided by the total earnings, you can take the price per share divided by the earnings per share. And these are values that are frequently seen in online financial websites. So you can take price per share, which is just the price of the share price, and divide by earnings per share. That will give you the PE ratio as well. Anything below 15 is considered the good PE ratio. Average PE ratio can be anywhere from 17 to 25. It really depends on the industry and depends on the company. But you can compare. In one industry, you can take two different stocks and compare their PE ratios and see which one's cheaper or more expensive than the other one. And so that's a great way to utilize the PE ratio. So what I've done is I'm going to show you exactly how to do that right now. So if we take like a good story stock right now, something like I picked Chipotle. So we take Chipotle Mexican Grill, and we're going to calculate the PE ratio using exactly what I just showed you. So I've made this nice little Excel sheet. It's pretty easy to use. I took, the top, what's that, 1, 2, 3. I took like the top 7 companies and kind of showed you their PE ratios here. And then basically what my Excel sheet does is just divides the total price by the EPS and gives you PE ratio. So let's look at Chipotle now. And you can see the share price is 368.27. So I'm going to go ahead, so we can kind of get a good example. Good way to compare stocks is to put in an Excel spreadsheet and kind of look at the different PEs. So here we're going to look at Chipotle Mexican Grill. Type in a CMG. And then take that share price today, which is Sunday, 368.27. And we're going to divide that by the earnings per share. So let me just squeeze this here. Okay. You can see the earnings per share last year was $9.23. So as of today, their PE ratio is 39.90. Just from what I said before, anything below 15 is good. So you should be able to tell from that this is a pretty high PE ratio. If you compare it with the top companies here in the stock market, you can see it's high compared to them as well. So this is one of those high PE ratio stocks that people are investing in right now, but I wouldn't be surprised to see the price fall pretty drastically once this bubble or rage about Chipotle kind of comes to a halt. Let's now compare that with another company in the same space, see if we can maybe find a better PE ratio. So I'm going to look over here to Big Lots, and we're going to do the exact same thing. I'm going to take the ticker, BIG. Look at the share price, 38.28. And we want to divide that by the earnings per share. So divide by 296. You get a PE of 12.93. You can see the PE there is much lower and much more favorable. So if I was doing a comparison, I would see, Big Lots is actually cheaper than Chipotle, so it might be a better buy. Now, you don't want to use just PE ratio when you're buying stocks. It's important to learn about all the other different things about stocks before making a decision, but this is a great place to start, and gives us a good idea of, right away, if we see a high PE ratio, maybe we should look somewhere else. So that's really what I do here, and I have this actual spreadsheet up on my website for my email subscribers. It's a free email subscription. I don't spam. All I'm doing is giving good content and giving updates such as videos like this or blog posts that I got on my website. So if you're interested and you want to have this nice little PE calculator spreadsheet, then go ahead and go on the website, www.einvestingforbeginners.com. You can click over on the right-hand side of the sidebar and enter your email, or also at the bottom of any of my posts, and you will get access to that spreadsheet as well as my free ebook. So enough about that. Now I'm going to show you the last two examples I've kind of done here to give you more of a visualization. So let's look first at Microsoft. All right, so what I did is I do a lot of research on stocks, and so I've taken all the historical data from their annual reports. You can figure out how to do this for yourself on my website as well. But so I've taken these reports all the way back to 1992, and you can see on this side of the spreadsheet, I've taken the share price and the PE ratio, and I've graphed them out to kind of see if we can get a visualization of how a high PE ratio should be avoided while a good PE ratio is more favorable. So here you can see as the PE is here in the red, as it drops, this right here signals a good time to buy, and as a result the share price jumps up here. But as the PE gets higher as the years go on, you can see it's starting to max out here, right here near 2000, which is near when the tech bubble was. And a lot of people were saying, internet stocks are the way to go. .coms is where you want to invest. Don't worry about PE ratio. And the price did go up high as the PE ratio went higher. You can see that. but it finally hit a point where the bubble popped at the highest part. The PE ratio here was about 60, and then boom, you just see share price fall, never gets back up to that point. And so as you can see, this really high PE ratio up in this area leads to the share price that never recovers. And so that's kind of one way where you can use PE ratio to kind of avoid these big losses. So I thought I'd visualize that for you. As you can see now, though, getting here in 2009, 2010, and then back down 2011, the PE is pretty low, and it's low compared to the share price. So it might start to look like a good buy now, but before, definitely when the PE was above 40, around 60, you wanted to avoid that. Unfortunately, not a lot of people did, but that's how it goes. Now I've taken another example here, I.B.M, and I did the same thing, took these values up here from the top, made them down into a chart here, and then into a graph. So down here you see they have negative PE. That happens when there's negative earnings, so don't think that a negative PE is a good thing. That's actually a bad thing because the company has negative earnings. So at a time when they have a negative PE, you see their share price fall. And then it's kind of stable, not really going, there's a little bit of growth here in the share price, but the PE starts to grow. You see right here how the PE for I.B.M, their PE shot up to 50 in 2002. At that peak, you can see that the share price peaked as well and then came down and was down for a while. So if you bought at the top where the PE was 50 in 2002 and you held on, for the next, you can see 3-4 years, you were in the red and you were pissed off. So really, I'm trying to emphasize that you should stay away from these high PE ratios. But you can see after 2002, a lot of people sold the stock, so the PE dropped. And when it finally stabilizes here, and you can see the PE is kind of in a downward trend in 2006, 2007, 2008, that's really a really great time to buy. And investors who did buy in 2006, 2007, finally got rewarded here in 2006 when it went up to 2008, and really got rewarded 2009 when the share price just shot up. PE still was declining, and that's an example of how a low PE can lead to great returns. So, I've hoped I've really helped you with this video. Tried to give you some examples and show you a really easy way to calculate the PE ratio. You can definitely expect to see more videos regarding different ways to analyze stocks, and I'm going to continue to give you these type of visualizations and Excel spreadsheets to help you out, all for free on my website. Again, that's www.einvestingforbeginners.com. You can get the free ebook, which I have here in my background, that I've wrote. It's a 40-page ebook giving you the 7 steps to understanding the stock market. I offer that all for free on the website in the hopes that I can help people learn how to invest and really get started, get your feet wet, buy your first stock, and eventually you will see some gains and some benefits, and I hope to help people learn through that. So I guess I've talked long enough here. I hope that this video was helpful, and I wish you the best. Thanks.